Good morning, everyone. I know it's unfair for me to do this while you're eating, but I'm going to do it anyways. Good morning, everyone.
Morning.
My name is Ben Forsag. I'm the Vice President of Strategic Partnerships here at the Portland Business Alliance. I want to thank you all for joining us. We are so happy that you're able to join us here today in person. We opened this office, the global headquarters of the Portland Business Alliance, in October of 2019 with big plans about how it was going to be used all the time. Those plans were derailed, obviously, for a few years, but we're really happy that we can get back to what we intended this for, which is bringing folks together and sharing important information for them and their business. The other real important thing about this room is just making connections. So there's going to be a lot of information up on the screen here, but I'd encourage all of you to take at least a few minutes to talk to the people next to you. Not you two, you already know each other. But just to make connections across businesses, because that's really where the magic is found in our association. So last summer and early fall, I started getting phone calls from people asking me about this tax credit that was associated with the payment protection program. And I said, not only do I not have the answers to your questions, I don't even know what you're talking about, because I am not the tax guy. And I reached out to our friends at Moss Adams and said, do you know anything about this? And they said, yeah, we talk about this all the time. I said, great, can you talk about it one more time for our members? So we're really pleased that they're able to come here and share their knowledge with us and share it with you all. This is a big opportunity. There are a lot of questions. The folks here are going to go through a presentation and then open up the floor to any questions you all have. And please feel free to share your questions. We want to hear what you have to say. Before we jump into the presentation here, I want to introduce a special guest we have, Grace Stratton. She's a representative with Senator Wyden's office, and she would like to share a few words and thoughts about the work the Senator's office has done in making this tax credit a possibility.
Ben, thank you so much. Thank you to the Portland Business Alliance and Moss Adams for coming together to bring this presentation to our business community. As Ben said, my name is Grace Stratton. I'm a field representative for Senator Wyden. Specifically, I cover Multnomah County, so I've had the opportunity, along with my colleagues, work very closely with Portland Business Alliance and appreciate the opportunities that they bring to you all. So I just wanted to come very briefly, high level, just a few minutes at the top to give a little background around this tax credit and also just offer our office as an ongoing resource. You know, Senator Wyden understands that small businesses are the backbone of Oregon's economy. And that's why as a top Democrat on the Finance Committee, as chairman, he worked so hard to get a bill that would provide the much needed relief for all of our businesses during the peak of the pandemic and now beyond. Senator Wyden's goal at the time was to keep workers on the job. He knows that if workers are able to stay on payroll, that they will be able to pay their bills, they stay connected to their healthcare and other benefits. It's really a win-win for our businesses and for the economy as a whole. So that was largely the impetus behind him writing and then securing the Employee Retention Tax Credit in the CARES Act, and then getting that extended in the American Rescue Plan in 2021. But like many other provisions and benefits during peak pandemic, we know there were challenges. So part of the reason I wanted to come here today was, again, offer myself as well as Senator Wyden's Finance Committee staff. Much like Ben, I'm not the tax person on staff, but we do have a lot of staff who are working on this day in and day out, along with many other important provisions that we wanted to continue to engage with our businesses around. So with that, I just want to, again, thank you all for your time today. I think there's going to be a lot of useful information about how to utilize this tax credit going forward. And if you all need to connect with me, I'm going to be sure to keep a stack of business cards at the end of the table over there. Unfortunately, I will not be able to stay for the entirety of the presentation, but wanted to make sure to just come and offer myself as an ongoing resource for you all. So on behalf of Senator Wyden, thank you for all that you do. And then we will continue the conversation beyond today. Thanks, Ben.
And with that, I would like to introduce our guests and presenters today. Coming from Moss Adams, great partners of the Portland Business Alliance. Thank you for your membership. We have Colin Quill and Mary Caitlin Wilcox. Mary Caitlin.
All right. So we're going to start talking about the Employee Retention Tax Credit, just to kind of gauge the audience. How many of you have taken advantage of this or are pretty familiar with the program. So I'm guessing everyone's new, don't have a lot of background behind it, kind of want to get a really good understanding of how the program works. Sounds good. So the employee retention credit, which we also kind of call as the ERC, basically it originated as part of the CARES Act. So it came out in March of 2020 to provide an incentive for employers to retain employees, even though their business might be subject to a partial suspension from a government order, or be financially impacted because maybe the need for your goods has shifted as we're kind of navigating COVID. This came out as an incentive to taxpayers to retain your employees and try to continue to pay them some amount of wages to avoid having to lay them off and then they subsequently go on government assistance. The ERC originally came out for the 2020 tax year. Then as we became close to the end of 2020, realizing things with COVID aren't changing, businesses are still being impacted. It was then extended through June 30th of 2021 as part of the Consolidated Appropriations Act. Again, as we got closer to the end of the first quarter of 2021, realizing businesses still needed some support, the tax credit program was further extended under the American Rescue Plan Act through the end of 2021. Then subsequently in the fall of 2021, the Infrastructure Investment and Jobs Act terminated that fourth quarter. There are rumors as to why it was terminated, but essentially where we stand today, the program is available to taxpayers for basically March 13th of 2020 through September 30th of 2021. So it goes through third quarter of 2021. There are two different ways businesses qualify, and the qualification criteria varies slightly between 2020 and 2021. So starting with 2020, the first way a taxpayer can qualify, which is the easiest way to document, is if you can show in any tax year, or excuse me, in any calendar quarter, 2020, the business had at least a 50% reduction in gross receipts compared to that same quarter in 2019, that can trigger qualification. Should a reduction in gross receipts not occur, the other way is if a business had a full or partial suspension of business operations. This bucket is very gray. It's not a black and white situation. It's very facts and circumstance based. We do have IRS guidance, but when you are looking to qualify under the full or partial suspension, there's a lot of legwork that comes into play. And we can talk a little bit more about what that means. But I kind of want to pivot to 2021 real quick. So 2021, similar fact pattern. It's either a gross receipts reduction or full or partial suspension from government orders. The difference is in 2021, if you have a calendar quarter in 2021 compared to the same quarter in 2019, so both years comparing to 19, you have at least a 20% reduction that can trigger qualification. So you're looking at this on a quarter by quarter basis for each of the years. So depending on which area you're trying to qualify, those are your percentages. Like I mentioned, gross receipts reduction, always recommend businesses start there. That's the easiest way to document qualification. If there are other commonly owned business entities, there are aggregation rules that apply. And we'll talk a little bit more about that. But something to take into consideration, ownership structures with other commonly or majority owned business entities, you may have to aggregate gross receipts in order to determine qualification, or you may have to aggregate looking at the impact to the business. So when a business is trying to qualify under a full or partial suspension, one measurement you have to reach is to be able to show that at least 10% of the business operations were impacted. So when we're looking at 10%, we have to take into consideration, are there other commonly owned business entities and are we aggregating? And if so, we have to look at all of the business operations that were impacted across all commonly owned entities. And together, can we measure that at least 10% compared to the entirety of the aggregated businesses is met? This program carries a lot of audit risk because there have been a lot of fraudulent claims. So when you are looking at this, that 10% rule in the aggregation is important. So I just want to emphasize that because that's an area where the IRS is identifying a lot of misinterpretation. A lot of businesses aren't taking that into consideration. And there's a consequence just from eligibility if that's not taken into consideration. The other thing that comes into play, which likely isn't going to be an issue with the businesses here, but the IRS has also set this term of large employer and small employer, and that definition varies slightly between 2020 and 2021. So in 2020, a large employer is any employer, even aggregated, that had more than 100 true full-time employees in 2019. Then you're considered a large employer. So as long as your true full-time headcount in 2019 was under 100, there's no limitation to what is deemed qualified wages in 2020 or 2021. If, in fact, you are over 100, there is basically what the rule is if you're under 100, all wages paid to all employees during the time that you're impacted qualify. If you're over that, you're limited to just wages paid to employees who could not work at all, but you continue to retain them and pay them at least some amount of wages. So maybe it's just a small percent of their normal pay, or you furloughed employees and continue to provide health plan benefits. The premiums paid for those health plan benefits, are considered qualified wages. So depending on your business and if aggregation is required and where that puts you on a full-time headcount for 2019, it can impact what you can consider as qualified wages, which then ultimately impacts the amount of credit that you can generate. So calculating the credit, again, slight difference between 2020 and 2021. For 2020, it's looked at as based on the whole year. So even if you qualify for 2 quarters or 1 quarter, the maximum amount of credit, and I'm going to approach this as if everyone in here has less than 100 full-time employees in 2019. Basically, you're able to account for up to $10,000 in wages per employee over the whole period of time in 2020 that you're qualified. And then the credit is a 50% credit, which ultimately means a maximum of $5,000 per employee for all of 2020. For 2021, the credit shifts a little bit and becomes a more material credit. The credit is up to $10,000 in wages per employee per quarter, and it's a 70% credit. So it's up to $7,000 per employee per quarter that you're qualified. So a much larger credit opportunity in 2021 than compared to 2020, but ultimately you can qualify for both years, and I believe it's up to $26,000 would be your total maximum credit that you can claim. This is a fully refundable tax credit. So the amount of credit that you generate will, at this point, since we're past 3rd quarter of 2021, effectively would be considered a refund to your business. And the way the IRS is distributing this is you would receive a physical check in the mail for the amount of credit. And in many cases, a small amount of interest applied to that because they are pretty significantly backlogged in processing these. But essentially, you would get this back as cash for the business. If you took a PPP loan, or if we have any restaurant businesses that also took a restaurant recovery fund, something to keep in mind is you can't double dip into all of these same programs. So essentially what happens is if you took a PPP loan and obtained forgiveness, You can still take advantage of the ERC. You just have to back out any of the wages you used for PP forgiveness. So wages used for forgiveness can't also be used in this program. So you basically just carve those out of your wages you were paid, and then you can take a credit on what's remaining. Same with the restaurant recovery fund. You just have to carve out whatever wages were used for that program, carve it out of what you're using to calculate this credit. The work opportunity tax credit. So the paid sick and family leave, this is under the Families First FFCRA, Families First Coronavirus Response Act. This was a payroll tax credit if you had employees who were sick with COVID or had to quarantine or get vaccinations, things like that. You were able to file for a payroll tax credit for the wages you paid to those employees during that time. That program can't use the same wages for both. So just take into consideration any other federal tax credit programs that are payroll related that you may have taken. There might be a position or a situation where you have to kind of adjust what's eligible for the ERC based on those programs and what the business claimed. I did kind of mention the ownership aggregation. Again, this is an area where a lot of taxpayers have gotten confused, and the IRS has identified that this is a big issue area. So something important to keep in mind if that applies to your business. Also, if there's foreign ownership, there's not a lot of clear guidance when it comes to the aggregation. However, based on interpretation, it appears that aggregation with foreign ownership applies with gross receipts, but it doesn't necessarily apply when you're looking at that full-time headcount. But again, guidance is not super clear. So if you have other foreign entities, something to take into consideration. Another thing that comes into play is, so this is a payroll tax credit, but it's also considered a federal income or federal tax credit. So even though you're using this, and we'll talk a little bit about claiming the credit, essentially you claim the credit through amending your quarterly payroll tax returns for the quarters that you're qualified. The tax years that you qualify and the credit amount that you claim. So normally on the federal income tax return, you take a wage deduction. Well, for this program, you can't take the wage deduction for up to the amount of credit that you claimed. So if in 2020 you claimed $100,000 in ERC, you'd have to go back and potentially amend, depending on your tax situation. You potentially would have to go back and amend your 2020 income tax returns to adjust that wage deduction for that $100,000 in ERC that you've claimed. Same thing applies to 2021. So that's another thing to take into consideration. If you haven't taken advantage of the ERC and you want to go back and take it, you might want to also talk with your CPA about your federal income tax filing situation to make sure that it makes sense to go back and make that retroactive claim for the tax credits. There are a couple of resources here. The IRS has issued 3 notices, and this is what we have as guidance for determining qualification. And when I talked about full or partial suspension and being kind of gray, the IRS has provided guidance into certain situations so that taxpayers can kind of use that as a basis to try to figure out, does my business qualify? And what are the parameters that we're looking at to really get comfortable with the position? This first notice here is kind of your base guidance. It has all of the main questions, answers. It's done in kind of an FAQ stamp format. That's your base notice with guidance. The next one down is it's an addendum for the first and second quarter of 2021. And then this third notice applies to technically Q3 and Q4. However, it kind of, as I mentioned, Q4 was later terminated. So a couple of resources for you to take a look at that kind of help explain the partial suspension to get kind of a good understanding if it could apply to your business. So with filing for the credit. So as I mentioned, it's a payroll tax credit. It does require amending your quarterly payroll tax returns to claim the credit for the quarters that you qualify. The statute of limitations to go back and claim a refund is essentially 3 years. And the way the IRS looks at payroll tax returns is even though you're filing them quarterly throughout the year, they effectively consider all quarterly tax returns filed in 1 year as being filed on April 15th of the following year. So for 2020 purposes, all quarterly 2020 941, so your payroll tax returns, are considered as filed April 15th of 2021. And basically what that means is you have 3 years from April 15th of 2021 to amend your 2020. And you have 3 years from April 15th of 2022 to amend your 2021 returns for this credit. So you still have time. The part where time kind of isn't on your side necessarily is the processing time with the IRS. Any refund claim that's over $200,000 goes into a secondary review, which can take up to 12 months. In some cases, we've seen 18 months. It depends for the refund. Anything under 200,000, we're seeing about 6 to 9 months. So there is a lag. And the reason for this is because so many businesses are qualifying for this, that the amount of refund claims that are coming in are just more than what they can process in a timely manner. So there is a delay on when you would actually get your refund checks back, which is why, as I mentioned at the beginning, there's a little bit of an interest added to the credit because of that significant delay. I do have a number on here with some prompts. This is so far the best way to get a hold of the IRS to try to get any information about your returns. If you call between 6 and 7 p.m., you can more likely than not get a hold of somebody who will answer your questions. If you call during the day, a lot of times you're on hold for hours or they hang up or, they're busy. So a number and some prompts to note for future, if you decide to take advantage of it, it'd be helpful in getting an update on where your returns are. Audit considerations. So as I mentioned, this program carries audit risk. And the reason for that is, as I mentioned, a lot of fraudulent claims. There are a lot of businesses that developed overnight to provide these services. They could charge contingent fees, but they're not going through the due diligence of determining that your business does in fact meet the qualification criteria, specifically as it relates to the full or partial suspension of business operations. I've included here, this is in the IRS, the first notice, that base notice I was telling you about. They do provide a section that says, what do taxpayers need to have to substantiate qualification? This almost mirrors an audit letter in what they, excuse me. This almost mirrors what the IRS audit notices are listing for what you have to submit to validate your qualification. Again, the most important thing is making sure with the full or partial suspension that all the due diligence is taken care of. That 10% threshold that I talked about, understanding if aggregation applies to your business. The other thing is, qualification is based on a government order mandating that part of your business be shut down. More than likely, that's only going to apply to any non-essential business operations that you have. And so you have to be able to show, like, this is the government order and this is how it impacted my business. And this impact is more than 10%. And then they're looking at, how did you determine qualified wages and, retaining copies of your returns. But most importantly is making sure you've done the due diligence to ensure that you qualify under the partial suspension. You've checked all the boxes to make sure that in good faith, your business does in fact qualify under that partial suspension. Okay. Open it up for questions. If you want me to repeat anything, expand on anything, if you have Any specific situations? Yes.
Could you possibly go over the revenue qualification again?
Yes. Yeah, so under the revenue qualification, so for 2020 purposes, you're gonna be comparing your 2020 calendar quarter. So even if you're a fiscal year filer, you're looking at calendar quarter revenue against, in 2020, against the same quarter in 2019. Because they want to look at, in the normal course of business, when COVID is not an impact, what were your gross receipts? And now with COVID being an impact, what are your gross receipts? And for 2020, as long as you can show there's at least a 50% reduction, that triggers your qualification in 2020. You stay qualified until you have a quarter where your gross receipts are less than a 20% reduction. So you look at Q2, Q3, Q4, and depending on where your gross receipts fall with those quarters, your qualification is triggered once you hit 50%. You stay qualified until your gross receipts are less than 20% than the 2019 quarter. When we're talking about gross receipts, the definition is the same as it is for tax purposes. The only exception is PPP forgiveness is not included in gross receipts. Otherwise, there's no exception. It's the same definition as it is for tax. 2021, you're looking at a quarter by quarter basis. 2021 compared to the same quarter in 2019, and you're looking for a greater than 20% reduction. That triggers qualification each quarter. There is a thing called an alternative quarter election, and I don't want to confuse you. I'm going to try to speak it out, but if I confuse you, let me know. Basically, they allow you, if you have a quarter in 2021 that does not meet the 20% reduction, but you have a quarter, the immediate quarter prior does have a 20% reduction, you can elect to qualify using the prior quarter. So for example, let's say Q1 of 21 compared to Q1 of 19, you have a 18% reduction. So that doesn't qualify you. But if you look at Q4 of 20 compared to Q4 of 19, you have a 30% reduction. You can elect to qualify for Q1 of 21 because under that alternative quarter election, because Q4 has a greater than 20%. So that look forward or look back applies to each quarter in 2021. So there is a chance you could qualify in Q1, Q2, and Q3. If you have 20% reduction in Q1 and Q3, Q2 can qualify using Q1. So again, I know it sounds really confusing and hopefully I didn't just confuse everyone, but there are some ways to kind of qualify even if you don't have a quarter that directly has that 20% reduction. Is that helpful? Yes.
Are there any restrictions to use the funds or, certain approved categories or anything?
For the refund?
Yeah, once you receive the funds back, can you use for anything?
It's just cash back to the business. So the intention is that you use that to pay payroll to keep your employees employed. Well, we're now in a period where we're now looking backwards and retroactively filing. So no, there isn't any specific use that those funds have to be used for at this point.
And maximum credit amount?
So the maximum credit amount, so for 2020, the maximum is 5,000 per employee. There's no limit to the number of employees. Yeah, it's just that employee by employee calculation and the maximum on an employee by employee basis.
Will you be sharing your slides?
Yes.
First question. Second of all, what if we had to let go of our employees in 2020 that we couldn't keep up with this businesses were not doing business? How do we do that? How do we allocate that?
So basically the way you're going to look at this is if, let's say we're talking third quarter of 2020. If you qualify, you're going to be subject to a credit based on whatever payroll you paid in that quarter. So if you had to lay off a bunch of employees and you didn't pay any payroll to them in that quarter before they were laid off, then unfortunately you wouldn't be able to generate a credit. It's strictly going to be based on the payroll that you've paid for employees that are still working during the time that you're qualified. So if you still qualify in 2021 and you've brought all of those employees back, but let's say you qualified because your gross receipts are down, you'd be able to then take a credit for the wages you paid to those employees because they're back on payroll and you're paying them, FICA wages. So basically it's whatever wages are paid in the quarter that you qualify. Thank you. Any other questions? We'll start on the we'll start on the end and we're going this way.
I've heard some talk about if you can't show that reduction, say, we have to do different things, either she kind of changing our business model or doing different things.
So this is where it gets a little gray. So the IRS does provide guidance where if you have to make modifications to your space. So let's say a couple examples. One, you have a limitation on the number of customers you can have in your space. So normally you would have 10 customers, but because you have to have 6 foot social distancing and these other things in place, and you can only allow 5 or 7 customers in at a time, that could be considered a partial suspension. So you're not able to fully provide the services to your customers because under a government order that says you can only have 50% capacity in your space, or you have to have a 6 foot spacing requirements for all of your customers. You can qualify because there's a government order that's saying you have to implement these restrictions in your space. And as a result of that, you can't service all of the customers that you normally would. That could be considered a partial suspension, but you'd have to kind of look at, does that cause at least an impact to 10% of my business operations? And so you'd have to look at, well, what part of the business is impacted by this capacity restriction? And how does that compare to the whole business? Does that make sense? Okay, sir.
My question is on the, when you file the amended 941 payroll tax returns, does the IRS require you to file the amended income tax returns at the same time?
So that's a good question. And this is a little gray area as well. So the timing of when you amend your income tax returns, there isn't anything that specifically says when. Your refund checks and the processing of your amended payroll tax returns are not done based on the timing of, so they're not holding them until you filed an amended income tax return. They're separately processing those in their department. So technically you would want to file, as soon as you realize you have this credit and you file that claim, you would want to make that amendment to your income tax return. But there's no guidance that specifically says when exactly the timing needs to occur.
What's what percentage of the requests for credits are getting denied?
So this is another good question. So while they're processing your amended returns, they're not vetting your qualification. They're basically just looking at kind of, does it seem reasonable, the amount of credit that you're claiming based on the amount of employees that you've claimed on your 941s, and based on, they're just kind of looking at the return and making sure it makes sense. The rejection of the credits or the denial of the credits is coming afterwards with these audits. We have seen a couple of situations where the IRS has issued a notice that basically says, we don't agree, or you claim 21 employees on your 941 and the maximum amount of credit you're claiming would be as if you had 30 employees. Like, we think that the credit you're claiming is overestimated. So they're not denying it. They're issuing you more of a letter kind of saying you should go back and double check your calculations. And then you can just file adjusted 941s in response to that if needed, but they're not specifically denying them while they're processing them. So it's really more in that audit. They did just train, I think it was 200 or 300 new auditors specifically to audit this credit itself. So, we might start to see more denials come through, but as of right now, the audits are starting, but they haven't completed. So we haven't seen a situation where a taxpayer has effectively been denied the credit and what that means. Are there penalties and interest? Are there other factors that come into play? We don't know yet. We're still waiting to find out. So the denial part, it's kind of may or may not occur. Does that help answer your question?
When you file for the refund, does that extend your credit statute of limitations? The timeline that the IRS can come back?
So the audit statute of limitations is when you file your amended. So yeah, so
Okay.
that would start when your amended payroll tax return was filed. Yeah. Yeah, so if you waited 3 years to file this, you'd still, that window for the audit would begin again from when you originally filed. Question.
You have a couple of questions. The first one is there guidance on how to calculate the average number of employees, whether it's 100 or 500?
Yes, so in that first notice, it's 2021-20. There is a section that talks about how to calculate that. And essentially what they're having you do is it's not like a traditional FTE count. They're having you take the total number of employees each month in 2019 that worked 130 or more hours. And then you take the total of employees from all 12 months that worked 130 or more, add that together and divide it by 12. So that's the guidance, and that'll be in that first notice. That's the guidance that they're providing on how to measure that 100 or 500 threshold.
Okay, my next question is, it's specific to our business, but in 2021, we brought in workers from Mexico under a work visa program through Homeland Security. And I was not able to use their wages for PPP loan qualification or forgiveness because they weren't here for 6 months. Would those wages be available for the ERC?
So it's based on the type of employment and if their wages are subject to Social Security tax. Because basically, if the wages are subject to FICA tax, then they should be qualified wages. I know that there's some guidance on, I think is it H1 or there's a term for a type of employment status or
H1B.
H1B, yeah. There is some guidance as it relates to that, so I don't know if that applies to the workers.
H2B.
H2B, yeah. I'd have to double check and confirm exactly, but essentially, as long as the wages you're paying them, the amounts that are subject to FICA tax should be qualified.
And they were.
Okay, then that should apply for this credit. Any other questions? Yes.
Is that like $5,000 per quarter or per year?
So the 5,000 is for 2020 qualification, and that's based on the whole period of time in 2020. In 2021, the max is 7,000, and that's per quarter. Yeah, so 2020, the credit's not as lucrative. 2021, it significantly goes up. And these slides, as we mentioned, you'll be provided a copy of the slides. And those notices, there's some notices in here that have kind of some of the base guidance that's helpful. A lot of FAQs and examples, you can kind of see similar like situations that might be similar to yours to help kind of navigate your qualification. Do you have a question?
Yeah, this might be basic, but is the credit for the payroll tax paid or the payroll?
Payroll.
Payroll.
Yep.
So
So it's based on the payroll paid. So the
Okay.
intent of the program is that you would be able to timely claim this. It would be used to offset your payroll taxes. And then any excess credit you generated beyond that would be refundable. But since we're retroactively looking at this, there's no real application to your payroll tax at this point. So it's just based on the payroll that you paid, the calculation off of that. Yes.
So for people that are students that came using OPT as their visa, and they're excluded from paying taxes for Social Security and other stuff, will they be considered into this program, or since they're not paying, will they be
So likely they wouldn't be qualified employees. You would likely have to use them in determining if your business is a large employer measuring kind of that full-time headcount. But from a credit perspective, I don't believe that they would be included since none of their wages are being subject to that FICA tax.
I see. Thank you.
Yes.
Is the payment actually a credit for future 941s? Or is it a check that's coming back?
It's gonna be a check. So they had originally the option where you could choose to apply it towards your future payroll taxes or get it refunded directly back to you. But what has been occurring is the timing of which, so real, like on time, regular payroll tax returns, the 941s are filed electronically. Amended returns have to be manually mailed in. And so the timing of when they get those and actually can process them, because of that lag time, if you don't pay in your taxes because you've got this credit, they're looking at this going, you haven't paid in your taxes. We don't have so far a amended payroll tax return for credit on file. So it looks like you're delinquent, and then you're getting letters saying that you haven't paid, and it's turning into a logistical and administrative nightmare. So the recommendation now is to just get a refund check to avoid dealing with IRS issues and things like that.
One last question. There's the 2020 and the 21. Are they two separate applications or one, just one application that covers both years? And the very basic question, where's the application at?
Yeah, so the application, basically what it is your amended payroll tax return.
Okay.
So there are worksheets at the end, in the instructions of the 941Xs. So your amended payroll tax return is a 941X. In the instructions, there are worksheets. And these worksheets basically have you work through, so it sounds really confusing, but they have you break out refundable and non-refundable credit. Essentially what that means is the refundable portion, the non-refundable portion is basically the amount of Social Security tax that you've paid. And the refundable portion is the excess. They have you break that up. However, it gets added something together at the bottom of the return, and you're gonna get a full refund. So they have worksheets that you fill out in order to effectively know what amounts are gonna be reported on which line item of the 941X. But you have to file a 941X for each quarter that you qualify. So if you qualify for 4 quarters, you're filing 4 amended returns.
Thank you.
Yeah. Any other questions?
Gets even more complicated if you have a pass-through entity, doesn't it?
There are a lot of things. I mean, the program sounds really amazing, but there are a lot of little things that come into play that it's really important to take into consideration before you fully file for the refund claim, just to avoid any further issues. But yeah, so that's why it's really good to talk to your CPA up front and kind of figure out, if we qualify, does it make sense to amend, and how does that impact the business, the shareholders, partner, however your business is structured. Do you have a question?
Yeah, so I'm sorry, you may have known this, but it's, when is the deadline to apply for this?
Yeah, so you have 3 years. Here, let me pull back that slide so I can show you. So this section right here is kind of talking about, so you have 3 years to go back, but it's not 3 years based on the quarter. The IRS considers, so for 2020 purposes, they consider all quarterly payroll tax returns in 2020 filed as of April 15th of 21. So April 15th of the following year. So your 3-year statute of limitation begins April 15th of 21 for any 2020 claims. So you have until April 15th of 2024. Yeah. And the money is coming out of Social Security and Medicare tax. So there isn't a specific amount of money that's been allocated for this program. It's just coming out of those buckets. So you have plenty of time to amend, and there's no real direct concern that the funding is going to run out.
Hopefully all CPAs are aware of this when we are going there to consult. They won't think we're crazy people because we lost our mind, right?
Yeah, I feel like everybody, I mean, I have friends that are asking who have nothing to do with tax, and they're like, what is this? I keep hearing about it. So hopefully they have.
Okay.
A lot of businesses are out there pushing this. So, there's a lot of information. I would just make sure that whomever you work with, if you decide to outsource it to somebody, make sure that whomever you're working with is doing their due diligence and making sure that, you do in fact qualify, because the IRS has already identified over 2 trillion in fraudulent claims. Basically, these businesses that are filing amended payroll tax returns who have never filed a payroll tax return before. Like, there's a lot of fraud going on with this program. And a lot of businesses are out there telling taxpayers they qualify without actually doing the work to make sure. You don't want to find yourself in that situation, so just make sure that you're vetting whomever you're working with to claim these. Moss Adams, we're doing this with our clients. We've been filing hundreds and hundreds and hundreds of these. I can't even tell you how many we've done. So if you have questions, looking for assistance, feel free to reach out to us. We've spent a lot of time in this area, and happy to provide assistance or answer some questions as they come up. All right.
Right, time for the bonus round. Are we on time? How much time do I have? Because I can go 5 minutes, an hour. What do you need?
More than 5 minutes, less than an hour.
6 minutes it is then. Well, thanks for having me. I'm so happy to be here. And the last couple of years I've been working side by side with my wife at home in like one little bedroom. And one of the things she told me is that I talk extremely loud. One, when I get nervous, two, when I'm getting presentations, which applies both to this case. And so she's also happy I'm here today, so she doesn't have to listen to it. Thanks for having me, letting me scream at you for a little bit. Who here has heard of the Inflation Reduction Act? 3, 4, 5. Who here knows what it is? All right, well, glad I'm here then. So we, if we're talking about ERC, and that's why you came, but now that we have you trapped, we want to talk about the IRA. And it's really, this is the hottest tax topic to come out in the last couple of years. Like, how much of your time is spent on IRA stuff now?
All my time now.
Yeah, and so in the hot tax world of things, this is a very, very big deal. So just a quick agenda for my piece. We'll give a quick IRA overview. We'll talk about the 179D deduction, which is kind of one of the tax incentives that was modified. We'll get into that. There's these incentive enhancements, which is really just these overarching concepts that kind of find their way into different parts of the bill. Direct pay and transferability, that's fancy words for grants and selling tax credits. And then if we have time, and it sounds like we don't, I can talk about specific credit programs, not really applicable to most of you in this room, but I want to have it on there just in case I had to fill some extra time. So what is the Inflation Reduction Act? It includes tax and non-tax provisions. It was signed into law on August 28th, 22 by President Biden. It actually fits to what we were talking about earlier with Senator Wyden's activity, because the Clean Energy for America Act that he introduced in 2015 was actually like wrapped into the IRA. And so Senator Wyden has his hands all over this bill as well. Some of the non-tax provisions, prescription drug price reform, that's really just, it allows Medicare to negotiate prices for certain drugs. ACA funding extension, so the subsidies were set to expire at the end of 22, that now goes to 2025. There's this IRS tax enforcement, which we've heard a lot coming out of the House now with the new leadership. What that does is it invests $80 billion over the next 10 years. And so this is the thing, if you hear like, oh, they're hiring IRS agents, $80 billion of agents, there's a little bit more to that. So $3.1 billion is for taxpayer services. And that's filing and account services, pre-filing assistance. So it's very taxpayer friendly sort of thing, where you think of IRS as a demon down there. Is actually pro taxpayer services. 25.3 billion of operational support, and then 4.75 billion of business system modernization. So if you're trying to call someone about ERC, you might be able to actually get someone on the phone faster once these investments are made. I've heard a lot of talk about how they're going to get rid of all the agents they've hired. Nothing's happened yet. And so it's just kind of talking points up there on Capitol Hill. Another tax provision is the 15% corporate minimum tax rate for corporations with more than 1 billion of income. Anyone here? 1 billion? All right, then a 1% excise tax on corporate stock buybacks. Then there's this whole suite of clean energy investment incentives. And while you might think right now, hey, I'm not in the business of clean energy, why do I care? This is stuff that can be used by everybody, whether you're involved in it or not. And we'll talk about that when we talk about transferability. These are a list of credits that kind of are either created or modified by the IRA. Some of them are pretty broad, like the renewable energy production tax credit. Some are very, very specific, like the nuclear power production credit. Don't know how many people are gonna be doing that one, but there's a whole suite of credits, it's really aimed at spurring investment and getting people to start building stuff that helps people out here in the United States. And we will revisit this list later with some added things to make you understand why you might even care about this junk. So the first incentive is the IRC 179D deduction. And that is an incentive to install energy efficient features in commercial buildings, lovingly called the energy efficient commercial building deduction, because tax people aren't very creative how they name things. So this is especially impactful to architects, engineers, construction industries, as well as commercial building owners. All right, quick background. It was made in 2006, made permanent in 2020, and then they changed the game in 2022, applicable 2023, by broadening who can get the credit or the deduction and how much you get for it. So eligibility. So pre-IRA, it was only available to commercial building owners and designers of buildings owned by government entities. And under the IRA,
Yes.
Okay. So under the IRA, REITs are now eligible to claim the deduction, and then designers of buildings owned by not-for-profit organizations, churches, private orgs, and not-for-profit schools and universities as well. So it really broadened the number of people that can qualify for the deduction. How much is the deduction and what's it for? So it's really for the installation of HVAC and hot water, interior lighting, and building envelope systems. Pre-IRA, it went from 60 cents to $1.80, depending on the energy savings. And that was adjusted for inflation through 22. IRA came in and just blew the door wide open. So now there's a base deduction and there's a bonus deduction. The base deduction goes from 50 cents to $1 based on the energy savings. But then there's a bonus deduction, which kind of supercharges it up 5 times the amount. So you can get up to $5 per square foot. And how you get that bonus deduction is really these concepts that carry over to a lot of the incentives within the IRA. So the local prevailing wage requirements and also the apprenticeship percentage hours. We'll talk about that in a second. Just know this is one of, I think, 2 or 3 things that have been issued guidance on so far. All the guidance has done is really tell you how to document these things. For projects to begin on or before January 28th, these don't apply. So you have 60 days from when the notice dropped, and that 60 days is January 28th. So, if you're building a nuclear power plant right now, you want to finish in the next couple of days. So what are these enhancements? What do they mean? So prevailing wage. So that is just, you can go on to sam.gov. You can look up geographic area, search by classification type of worker, and you just have to pay people the minimum rate. And this applies if you're paying them directly, if you're going through a contractor or subcontractor. They want to make sure that people are getting paid fairly for their services. And then there's an apprenticeship piece as well. And that's just people have to go through apprenticeship programs that are qualified by the Department of Labor. And that percentage is 10% for 22, 12.5 for 23, and then 50% for each year after that. So if you meet these, you get that 5x boost to your incentive. But wait, there's more. There's more bonuses here. There's bonuses for a couple of the credits for the production tax credit, investment tax credit, 10% if there's this domestic content requirement. So if 100% of your steel that you use in your project is American made, or 40% of your otherwise like all your manufactured stuff is made in the US, you qualify for that. But then if you're looking at an energy community, which can be a brownfield site, you know, areas where there's high activity in extraction of coal, oil, or natural gas, areas of high unemployment, or communities around closed coal mines. So I'm guessing the policy there is trying to get people who may have lost their jobs something else to do, to make sure that we're not just closing coal mines and taking away people's livelihoods. And there's also a bonus if you're looking at low-income community, some exemptions there for smaller projects, or if you come within that 60 days, so January 28th. So how does this look? Okay, so you got your let's call it a base credit of 6%. You got that down here. You meet your prevailing wage and apprenticeship requirements. You get your 5x total of 30. You use a bunch of American-made stuff. You get extra 10% on top of that. And then if you're located within the energy community or low-income community, you can get another 10, sometimes 20%. So, just quick math, if you have $1 million investment, you can get up to a $500,000 tax credit, which is that's a huge tax credit. And, you might be asking yourself, what if I don't have liability to use all this $500,000 of tax credits? Or, I need that money up front. When this direct pay and transferability provisions come into play. So a lot of these credits allow you to be paid. It really just looks like a grant. So you just convert your credit into a little bit of cheddar cheese in your pocket up front. It's available to tax-exempt entities, state or local governments, Tennessee Valley Authority, whatever that is, Indian tribal authorities, and then any Alaska Native corporations and co-ops engaged in electricity supply. The hydrogen credit, the carbon credit, and then the new, I think it's PTC, they don't need to be within here. So anyone earning these credits can get a payment. Okay, transferability, and this is what I really wanted to get to. Who here pays federal income tax? There we go. There we are. All right. So transferability of credits is something that we've seen for a long time on the state side of things. So here in Oregon, we've had a number of transferable credits. The biomass credit, for example, which is turned into the bovine manure credit for some reason. And then the ag worker housing credit, for example. So what happens is you do something, they give you a piece of paper that says, congrats, you got a tax credit. You could then sell that basically to another person at a discount. So, the biomass credit, you had to sell at 90 cents on the dollar. $100 credit, you pay 90 bucks for it. The buyer gets $100 in credit that they pay 90 bucks for. And then you would be able to monetize your credit because either you don't have liability or you need that upfront cash to help fund your business activities. And this transferability piece was unheard of on the federal side of things. But now we have federal transferable credits, which just it's in our worlds, this is a crazy concept to think about now. What this is eventually going to look like or how crazy the market's going to be, we really don't know yet. But it's eligible for project place of service after 1/1/23. You can transfer a part or all your credit only one time, so you can't go into the business of buying and selling tax credits. It's not taxable to the transferring party. They're general business credits, so carry back 3 years, carry forward 20 years. There is recapture. So sometimes the tax credits, if you stop doing what you're supposed to be doing, you have to pay the credit back, essentially, and that transfers with the transfer. So if you buy the credit, you're on the hook if someone messes up and doesn't do what they're supposed to be doing, which can be tough. A lot of these credits are 10-year credits, so you have to be eligible for 10 years. Or there's clawback provision, things like that. There's a timing issue there as well. What time is it? I don't know.
You're good.
There's think about when you want to claim the credit. Won't get into too much detail there. Yeah, question.
So for some of these companies who are going to do chip buying, these chip companies can they use this and the direct pay on the slides before to purchase. They're gonna do a lot of research and development buildings. I know OSU is gonna do a big building. Are they able to use that and private companies able to use that provision to build some of these new chip companies?
Yeah, so not for like the chip credits themselves. I know a lot of grants and things like that. But if they qualify under any of the other credit programs, so like advanced manufacturing, or they're building batteries, for example, in a lot of these systems now. So I don't think the incentives under the CHIPS Act, for example, fall under here, but there is a lot of overlap between the two.
I was gonna say, I think 48D though, this, the CHIPS Act itself does allow for direct pay.
Okay,
So it allows for refundability, right? Grant refund, I think.
but they can only do that on one project if they do the direct pay,
Well, so basically you would have a qualifying facility,
right?
right? And so whatever is qualifying under that umbrella of how you define your facility, and what qualifies for, say, the CHIPS Act, right? For what
Right.
they're manufacturing, then that investment would be, I think it's a 30% credit under the 48D section. I should know this. I wrote an article on it. And then you would basically go through the process of claiming a refund. And so we, like Colin was saying, we don't know the process yet. It implies that you have to file some sort of a return to get this direct pay / refund concept. But then you
But
think
you don't.
about not, tribes that don't file tax returns, right?
Right.
How are they going to claim it? So again, a totally, in the dark about how the IRS is gonna handle this whole concept of what you have to file to actually claim this refund.
And this is Irina Antonakis, she managing director in our office, does only credits and incentives work, and much more than I am.
IRA is our world right now.
So some of the kind of ongoing questions is it going to be similar to state programs? Like, are you going to get a certificate? A lot of times for a lot of these federal credits, you don't. You just kind of claim it and hope you don't get audited. And then, for the prevailing wages or apprenticeship programs, are you going to have those be certified in some way to prove to a transferee that, this is real? Or if you're just going to have to provide them all the documentation you have, we don't know. And then, kind of the legal landscape of it all. How are purchase and sale agreements going to be structured? Are there going to be indemnities against that recapture? And if are people going to start insuring tax credits or insuring your right to claim the credit once you buy it? These are all things that are going to have to be considered moving forward. Another thing is whether individuals can purchase the tax credit and use it to offset their personal income taxes. There's been some mentions that that's not going to be a possibility due to passive activity rules, but we don't know yet for sure. Everyone's just sort of talking. Nobody knows anything now. And then whether it's going to be the offset limitations for corporate taxes and any state tax applications on the back end. And so you might not be building a nuclear facility, but might be able to purchase a credit that was earned for building a nuclear facility and use that credit to offset your taxes. So this is kind of a chart of all the credits I mentioned before. In this column here is where they have that bonus provisions for the prevailing wage and apprenticeship programs. So these are all, those boosters. All of these credits are eligible for direct pay. The X pluses are those that are not limited to certain types of entities. And then all of them are transferable except for the qualified commercial clean vehicles credit. And so this is by far the biggest change of kind of federal incentives we've seen in my lifetime, which isn't saying much, but
What's the advanced manufacturing production credit?
so they,
What kind of things qualify for that?
it's the manufacturing of clean energy.
Okay.
So
products,
it's,
basically.
yeah, so it's a manufacturing of batteries that then go into vehicles or battery storage, solar panels and wind. So solar, wind and storage components.
Here's a slide on that, if I had time to get to it. And so, yeah, so these credits kind of broken down into two buckets, I think of it. One is the investment tax credit, which means you're getting a credit for spending money. And then there's a production tax credit, which is earning money for producing something. And so this one is one that is for investing. So if you invest in clean energy, equipment or facilities, you're eligible for the 48C credit. Go back to that slide. It's way back there. Is there any other questions, kind of big picture on IRA? So I think, the two things that I wanted to convey is one, the 179D deduction, because everyone can take it. There is some provisions related to residential buildings as well. But that's only for like 4-story tall residential buildings. And then I wanted to let you know about transferability and how you may have the opportunity soon to buy federal tax credits. And save yourself a little bit of money. Questions? Well, I'm available if you have any questions or anything come up, feel free to reach out. Otherwise, I'll wrap it up. Maybe like talk about tax on Monday for too long.
It's your dream Monday?
I mean, yeah, it's my every day, but.
Well, thank you, Colin and Mary Kay, for sharing this information, and kudos for knowing it all. Kudos all of you for all your nodding heads. You seem to understand what they were saying, which is more than I can say for myself, so. Can I ask if folks needed more assistance? They could certainly reach out to Moss Adams for support, right? What's the best way for them to do that?
Probably via email. I have some business cards with me I can leave, or we can, I don't know if there's a way to distribute.
We'll black out the slides.
Yeah,
Oh, perfect.
Yeah.
So we have the slides. We've also been recording this presentation. So we will send out the recording and the slides to everyone after the fact. If you have any questions, please feel free to follow up with our folks at Moss Adams, as well as the representative from Senator Wyden's office. Yes.
Grace from Senator Wyden's office left a bunch of her cards as well. She did say that they have some assistance with IRS if you're getting a response from them or no response from them. I don't like, you can contact their office. They will help troubleshoot as well.
Sounds good. Yeah.
Through this law, is it a minimum 10-year tax credit? Because it looks like a lot of them are 10-year.
It depends on the program.
Yeah, so in general, the investment tax credit, it's a 1-year credit, right? When you place the eligible property in service. And then a production tax credit is either, really, I think one of them, I think it's a carbon sequestration. I want to say runs 12 years. Most of them run 10. And then your credit is really each year, right? Based on what you produce and sell, depending on the qualifying factors.
And there's some limitations on the direct pay and transferability. Some say you only do it within that first 5 years of your 10-year window.
Thank you.
I would say the one thing I'd want to just to point out to the group from I'd say the generic, right, production tax credit or investment tax credit was for production of electricity. The biggest and newest piece of this was allowing for battery storage to qualify, right? So if you have a building like this and you install a huge battery storage factor to it that stores energy and then uses it for the building in, peak hours, that is now a qualifying investment. And so that's a very kind of big change. And then the other big change is not just production of electricity, but natural gas is also now eligible for an investment tax credit. So equipment that produces natural gas as opposed to just electricity. So those are really, kind of two big ones that I think will open it up to more, say even normal businesses, right, to benefit from.
Yeah, a lot of these programs were specific to certain types of projects, and they're moving to more like technology neutral options.
Yep.
Any other last minute questions? Could we have a round of applause for our presenters? And with that, I'm gonna bring this event to a close. You're all welcome to hang out here for a while. We have the room booked until 1 o'clock. I don't think we've got anyone else in here after that. I would like to remind you all, as members of the Portland Business Alliance, this is your space. So if you ever would like to host an event here or have a meeting, you want to impress some clients with a somewhat cloudy view of Mount Hood, let us know. This is your space and it is available to all of our members at no cost, as long as it's not being used by someone else. So feel free to reach out to us. We're happy to serve you and we hope to see you again in the future. Thank you.
Thank you.